In this Foundation Series video, we are going to be discussing short-term care insurance. This product was designed to protect your clients from financial loss due to the current shortfalls in Medicare benefits and our clients' inability to either qualify for or afford long-term care insurance. Seniors today can run headfirst into devastating financial circumstances if they don't understand these hidden health insurance pitfalls and how they can protect themselves by utilizing STC insurance. One such pitfall is commonly found when a hospital uses observation care status. This observation care status is supposed to mean that the patient is being watched while doctors decide if they can be discharged, or if they are ill enough to be admitted as a true inpatient. Observation typically is supposed to last 48 hours or less. The problem for Medicare beneficiaries is that observation services can result in unexpected expenses. They are considered outpatient care even if the patient is in the hospital for several days. That means that the visit isn't covered under Medicare Part A, which covers the total cost of hospital services after deductible. Instead, the patient knows co-payments for services under Medicare Part B, which covers outpatient care. This could be a huge financial hit, and it would actually come after the hospital stay ends if the patient was transferred to a nursing home. Medicare does pay for nursing home expenses, but only if the person was an admitted inpatient in a hospital for at least 3 days, not counting the discharge day. And they also have to meet the other requirements for Medicare benefits in a nursing home. If a person's entire stay was classified as observation care, it would keep them from qualifying for Medicare benefits in a nursing home. The nursing home bill could mean potentially thousands of dollars in out-of-pocket expenses. Another coverage pitfall is the prospective payment system used by Medicare to pay nursing homes. To control rising healthcare costs, the federal government in 1983 established a prospective payment system to reimburse hospitals for the in-hospital care of Medicare patients. The prospective payment system changed the way Medicare reimbursed hospitals. It went from a cost or charge basis to prospectively determined fixed price system in which hospitals are paid according to the diagnosis-related group, or DRG, into which a patient is classified. The intention was to incentivize hospitals to become more cost-efficient by allowing them to keep any unused DRG payments as profit. However, if the cost of care exceeded the DRG payment, the hospital had to absorb the loss. This created a situation where hospitals were incentivized to release patients quicker and sicker. Often, patients had to continue their care in a different setting, which led to short-term nursing home confinements becoming part of the hospitalization process. A trend started to arise where many hospitals purchased nursing homes or converted entire wings of their hospital to a skilled nursing facility in order to provide recuperative care. Many patients failed to realize that when they were transferred from one wing of the hospital to another, that they had actually been admitted to a skilled nursing facility. Prior to 1997, Medicare reimbursements to nursing homes were based on actual costs submitted on each patient. The Balanced Budget Act of 1997 forced Medicare to phase in a prospective payment system for reimbursement for nursing homes, which is now fully implemented. Payments are now determined for each patient based on pricing formulas determined by the intensity of care needed, as well as the number of anticipated days of care. This creates an environment whereby nursing homes have a financial incentive to terminate Medicare benefits early and convert patients to private pay. Not only must the patient meet the strict Medicare criteria for collecting skilled nursing facility benefits, but they also have to deal with regulations such as the implementation of the prospective payment system in 1983 or the Balanced Budget Act of 1997, all which altered the landscape of receiving care. Here are some additional facts commonly associated with short-term care insurance. At least 70% of people over 65 will need long-term or short-term care services and support at some point in their lives. The national median daily rate in 2014 for a private room in a nursing home was $240, an increase of 4.35% from 2013. The average length of stay for those patients who are able to be discharged is 272 days, or approximately 9 months. 38% of nursing home patients will eventually be discharged to go home or to another setting. In summary, there is a major need for short-term care insurance in the senior market today. Without proper planning, a serious accident or illness could rob your clients of their financial independence.